Okay, let's dive right in. We are looking at a system that is pound for pound probably the single most profitable commercial idea humanity has ever had.
And here's the really wild part. It creates these, colossal profits without ever making a physical thing.
Right. Not a single product, no raw materials, nothing.
We're talking about debt and credit, but not just as, a simple financial tool. We're talking about it as the invisible engine of the whole global economy.
And that's really our mission for this deep dive, to get past the idea that debt is just, I don't know, a way to buy a house or a necessary evil.
Exactly. The sources we're looking at frame it as this invisible force that has bankrolled wars, brought down empires, and this is the key, has been quietly funneling wealth upwards for centuries.
It's so embedded in our daily lives, isn't it? Mortgages, credit cards, student loans, we're all participating in it.
We are. And most of us don't realize we're feeding this incredibly profitable, self-perpetuating machine. So if you really want to get a handle on global power and finance, you have to understand the history of debt.
So let's start at the very beginning then. What is the actual product here? We call it a loan, but what's the mechanism that turns a simple promise into a profit engine?
Well, at its most basic, a loan is just getting something today and promising to pay it back tomorrow. Simple. But the product, the thing that creates the control and the profit, isn't the loan amount.
It's the interest.
It's the interest. And what's so fascinating and a little terrifying about interest is that it literally turns your future time, your future work, your future earnings into immediate cash for the creditor.
So they're not selling money, they're selling your future. Monetized time. And it seems like ancient societies really understood how dangerous that was.
Oh, absolutely.
Yeah.
For thousands of years, civilizations really fought against the idea of charging interest. We see it so clearly in Mesopotamia. They kept meticulous debt records on clay tablets, very sophisticated stuff.
But they also had a release valve,
A
right?
huge one. They had what are called debt jubilees. These were periods where all debts were just erased, wiped clean, often when a new ruler took the throne.
Wow. Why do something so extreme? A total reset seems drastic.
It was pragmatic. The leaders knew that if too many people became, completely enslaved by debt farmers losing their land, citizens losing their freedom, the entire social fabric would just break apart.
It leads to revolution,
Yeah.
instability.
Exactly. And you see this idea in other places too, like in ancient Hebrew texts. They prescribed debt cancellation every 50 years to keep the community from tearing itself apart.
Yeah.
They saw systemic debt as a threat to the state itself.
That is just such a fundamentally different worldview. They saw forgiveness as necessary for society, whereas today we see paying your debts as like the most sacred rule of the market.
And that's the turning point. Over centuries, the elites learned a very different lesson. Not how to erase debt, but how to weaponize it.
Okay, let's follow that thread. We jump forward to medieval Europe. The Catholic Church officially forbids usury, charging interest. They saw it as sinful, yet finance and banking just exploded. How did they get around that?
They were clever. Very clever. They just didn't call it interest.
So they disguised it?
They disguised it as a fee for risk or a penalty for late payment on a commercial contract. They would build it into currency exchange rates, anything but calling it a loan with interest.
And this is where we see the first great banking dynasties, like the Medicis in Florence. And they weren't just lending to small merchants.
No, no. They were lending to kings, to popes. They built an entire empire on finance, not on land.
Yeah.
They had immense political power because if a king owes you money, well, you have a say in that king's decisions.
So debt becomes a tool of political authority.
It becomes the engine of it.
Which brings us to this massive shift in the 17th century where debt stops being a private tool and becomes the very foundation of the modern state.
This is the revolution of state debt. The Dutch Republic is the classic example. They were fighting for independence from Spain, a hugely expensive war.
And they didn't have enough gold in the treasury.
Exactly. So what did? They started selling obligations, what we now call bonds, to their own citizens. Investors got regular interest payments, and this is crucial, they could sell those bonds to other people.
That's a game changer. It sounds simple, but it completely changes the nature of warfare, doesn't it?
It changes everything. War is no longer limited by your pile of gold. It can be funded indefinitely because you're basically just selling the future. As long as people believe the state will survive to tax the next generation, they'll buy the debt.
And the British perfected this model.
They did with the Bank of England in 1694. This made the national debt a permanent part of the state. The government started living on a rolling line of credit.
Which made the bankers who managed this whole process
Indispensable.
Yeah.
They were no longer just financiers, they were the managers of the state's survival. The state went from fearing debt to being built on it.
And the profit loop that this must have created for creditors is just staggering to think about.
It was almost a perfect system for them. Lending to a government became the safest bet in the world.
Because they can always tax people to pay you back.
They have the ultimate collateral, the entire population's future earnings. This creates a self-reinforcing cycle. You fund more wars, which leads to more colonies and more markets, which creates more opportunities for more debt.
A perfect profit machine.
And for a long time, this power was centered in the big bond markets: London, Paris, Amsterdam. The real decisions weren't happening in palaces, they were happening in financiers' offices.
But eventually, that machine had to expand. It couldn't just stay at the level of governments. It had to target everyday people.
And that's the next major shift with industrial capitalism. First, the infrastructure of the modern world, railways, factories, it was all built on massive amounts of credit.
And then the workers in those factories became the next target market.
Exactly. They needed houses, they needed tools, they needed to buy the very goods they were producing. So by the 20th century, credit wasn't just for kings anymore. It was a mass market product. Mortgages, car loans, installment plans.
Borrowing became the normal condition of life.
It was sold as the path to a better life.
Which brings us to the hidden genius of it, or maybe the cruelty of it. A debt is not designed to be a one-off transaction.
No, absolutely not. The ideal situation for a creditor is not for you to repay it quickly. That stops the profit stream. The system is designed for the debt to be permanent,
A cycle of payments that can last for decades.
because every single one of those payments, every month, is a small, guaranteed transfer of wealth from the debtor to the creditor.
From the many to the few.
From the many to the few. Think about a 30-year mortgage. By the time you're done with all the interest, you may have paid 2, maybe even 3 times the actual price of the house.
That one loan becomes a massive, predictable source of income for the bank over a very long time.
It's an unrivaled business model. You're generating wealth from time itself. You don't need a factory. You just need a contract and a signature.
And the people who mastered this, from Amsterdam to Wall Street, they became the architects of the modern financial world.
And after World War II, this whole machine was basically institutionalized on a global scale.
You're talking about Bretton Woods, the creation of the IMF and the World Bank.
Exactly. On the surface, they were created to stabilize the global economy. But debt became a tool of, geopolitical discipline.
How so?
Developing nations could get loans, sure, but the money always came with strings attached. This is where we get the idea of structural adjustment programs, or SAPs. The IMF would attach these conditions to its loans, and they were extensive.
So this is more than just making sure they could pay it back.
Oh, much more. These SAPs often forced countries to rapidly privatize state-owned industries, their utilities, their oil companies. They had to slash spending on health, on education.
So the debt became a lever to remake their entire economy in a certain image.
It effectively compromised their national sovereignty. The real policy was being written in Washington or Basel, not in their own capitals.
And at the same time, back home in the developed world, that consumer credit revolution was just exploding.
The psychological change was incredible. Debt went from being a source of shame to a symbol of prosperity. The buy now, pay later culture took over.
And the most profitable customer was the one who didn't pay off their credit card balance every month.
Of course. The goal was dependence. Keep the debt rolling over. That fueled this illusion of endless growth, even when real wages for most people started to stagnate.
But a system built on ever-increasing debt is bound to have crises.
And it did. A major one with the 1982 Latin American debt crisis. These countries had been encouraged to borrow huge amounts of U.S. dollars.
And then interest rates in the U.S. went through the roof.
They skyrocketed under Paul Volcker at the Fed. Suddenly, the cost of repaying those loans became impossible for these nations. They were facing total collapse.
And the solution offered wasn't forgiveness.
No, the solution was more loans. But under even stricter structural adjustment terms, it was a trap. They had to borrow more just to pay the interest on what they already owed, losing more control with every cycle.
Which protected the creditors.
It always protects the creditors. And this is when we really enter the age of financialization, where the debt itself becomes the product.
Right, this is where it gets really abstract. Securitization.
Yes. Investment banks started taking thousands of mortgages, car loans, you name it, bundling them all together into these complex new products and then selling slices of that bundle to investors all over the world.
So they weren't just profiting from the interest payments anymore. They were profiting from slicing and dicing the promise of future interest payments.
Precisely. Wall Street became less about funding businesses and more about engineering these incredibly complex instruments of debt. And it created this illusion that risk had been eliminated, that it had been spread so thin it couldn't hurt anyone.
Which led us straight to 2008.
The logical endpoint. The U.S. housing market collapsed, and all of these complex debt products built on top of it imploded.
And when the dust settled, who got bailed out?
The creditors. The big banks, not the millions of families who lost their homes. And the most shocking part is that after the crisis, global debt didn't go down. It went up dramatically. The system was just too big to fail.
So where does that leave us today? We're sitting on a mountain of global debt, over $300 trillion. That's more than 3 times the entire world's annual economic output.
And we're told that this is just growth. But what this system really does now is anchor inequality.
How does it do that?
Well, think about it. The wealthy can borrow money very cheaply, using their assets as collateral to buy more assets that go up in value. They use debt to get richer.
While for everyone else, debt is expensive. It's student loans, credit cards. It's a tool for consumption or survival, not investment.
Right. And those interest payments are a constant, slow transfer of wealth from their future labor upwards. Debt perfectly mirrors and reinforces the class divide.
And now this whole machine is set to evolve for the digital age with things like central bank digital currencies, CBDCs.
This could be the next frontier of control. A CBDC is essentially programmable money, issued directly by a central bank. It's completely traceable.
What does programmable mean when it comes to a loan?
It means the rules of the money could be coded directly into it. A loan could be algorithmically approved or denied. Interest rates could be changed in real time based on your behavior or economic conditions.
That's a level of microcontrol that is just unimaginable in the past.
If history shows us that more efficiency for the creditor always means less freedom for the debtor,
Then this promises the tightest control yet.
it's a profound shift of power toward the center.
So to wrap this all up, the main takeaway from our sources is that debt was never really a neutral tool.
Not at all. It was deliberately cultivated over centuries to be the most profitable product in history. It's a machine for converting the future labor of millions into a perpetual stream of income for a very small number of people.
So true financial freedom, then, really means minimizing your dependence on this system. It means questioning every offer of easy credit.
You have to see the machine that's hiding behind the offer. It's designed to profit from your future for as long as it possibly can.
And the cruelest trick is that we've been taught to celebrate it, to call borrowing prosperity.
To call access to credit opportunity. But the history, from those ancient clay tablets to Wall Street derivatives, tells one consistent story. The world is shaped for the benefit of those who control the money, not those who merely use it. And now that you can see the machine for what it is, what do you do with that knowledge?